Imagine having $100,000 in your trading account by tomorrow morning without risking a dime of your own savings to get it. Proprietary trading firms offer exactly that. They provide the institutional capital, you provide the trading skill, and the two of you split the profits. This chart shows the reality of the required evaluation test you have to pass to access those funds. 95% of applicants fail and walk away with nothing. That massive failure rate illustrates a specific reality. The evaluation rules target biological responses, forcing human traders to compete in an environment where their own instincts work against them. The mechanism is found in the firm's strictest rule, a 5% daily loss limit. When a trader watches their account drop to a 4% drawdown, biological stress kicks in. They experience a flight or fight response, over-leverage positions to recover the loss, and ultimately disqualify the account. Because human emotion is a consistent point of failure in this specific environment, the alternative is to completely remove the human trader from the execution process and replace them with a machine. The first phase involves automating the bypass of the prop firm's initial evaluation barrier. This is achieved using high-frequency trading, or HFT, bots, deployed on challenges that have no minimum trading day requirements. This chart illustrates how the bot identifies the bid-ask spread and exploits microscopic gaps to execute hundreds of profitable trades in fractions of a second. This speed satisfies the entire profit requirement in under 20 minutes. The initial barrier is essentially a test of execution speed, a metric where algorithms possess a mathematical advantage. Once you move to a live funded account, the 5% drawdown limit remains the primary risk to your capital. We counter this with an equity protector script, also known as a volatility buffer. The script functions as a technical barrier between your terminal and the prop firm's server, monitoring equity in milliseconds. If market volatility pushes the account near that 5% threshold, the script executes a hard exit. It severs the server connection and locks the terminal. This prevents the firm's system from registering further losses and disqualifying the account. The script ensures survival by physically preventing human panic from interacting with adverse market volatility. With the account protected from sudden drawdowns, the final step is ensuring long-term profitability. This is handled by risk-to-reward ratio, or RRR, automation. This bar chart shows the algorithm enforcing a rule where potential reward is exactly 3 times the risk. As this grid shows, you can lose 65% of trades and still maintain a profitable account through this mathematical ratio. Profitability becomes a function of letting a mathematical certainty play out automatically over time, rather than predicting every market move. Together, these 3 layers, high-speed execution, the volatility buffer, and automated risk ratios, function as a single unified stack. Combining these tools neutralizes the specific psychological pressures built into the prop firm model. The traditional path of compounding a small account over years is no longer the only way to reach professional capital levels. The current financial landscape favors those who use code to navigate traditional barriers to entry. Accessing 6-figure capital now depends more on the architecture of your system than the size of your initial deposit. While an emotional retail trader faces significant psychological hurdles, a solo quant manages the underlying systems to maintain consistency. Instead of playing as manual traders, scale to institutional capital levels by becoming the system architect.